Welcome, I'm Jennifer Stowell, and Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all of our meetup groups all around the world. We have organized, promoted, and produced over 2,499 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at www.ideatoipo.com. Our featured speaker today is Roger Royse, one of the top startup and venture capital attorneys in Silicon Valley. And he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royse. Roger, take it away.
All right. Thank you, Jennifer. Thank you, Idea to IPO, for hosting this event and producing and doing everything. I'm just the speaker, but here I am going to speak tonight on all new content tonight, how to successfully implement an exit strategy. I have a few housekeeping items before we start. First, I want to let you know that this is being recorded. If you want my slides, you want the recording, you'll get an email from me after this is over with a link to the recording. And if you'd like the slides, you can have the slides. And I'll also ask if you want to join my mailing list, and I won't be offended if you don't. At least I won't tell you that I am. You'll have that opportunity. Notice that there's a chat box there's a chat box and there's a Q&A box. So in the chat box, you can talk to each other. So normally when we used to do these events live, it was a networking event. People could come together, they could sit down, they could talk to each other, have a slice of watermelon and fruit and other healthy snacks, and exchange business cards. We can't do that now, but you can use your chat box to tell people who you are and what your company does, and etc. So feel free to use a chat box. This is the last event. In fact, I'm going to do it right now. I'm going to send to you. Whoops. Yeah, that's what I get. I'm going to send to you through the chat box my contact information. All right, I'll do that again before we're done, but that gives you an idea of how to get a hold of me. And that's the next thing I want to tell you. If you want to get a hold of me directly, use any of those links. It's my LinkedIn. You can link with me on LinkedIn. You can tweet to me on Twitter. You can friend me on Facebook. You can find me on my Haynes and Boone page, my bio page. You can send me a photo on Instagram. There's something you do on live.com. And I've got like several, I'm on every social media platform there is. Even the ones that are probably no longer allowed to operate in the US, at least not in the past. So go ahead and track me down. I'm easy to find. I'm not hiding. Now, as we go, if you are going to be tweeting, and I hope you are, use the hashtag Idea2IPO. Spell out the word "to," Idea2IPO. Go ahead and tweet some of these good comments that we're going to have. We are streaming live on Facebook right now. This is the last event of the year for me. I guess Rob might have a few others, but this is the last one for me. So before we get rolling, we've got enough people here that let's find out who's in. All right, we've got a pretty good number of attendees. Let's find out who is in the audience. I'd like to know who you are. What is it that you do? Are you a startup entrepreneur? Are you an established company or a more mature company? Are you an investor, a service provider? Are you in school? Are you a student? Go ahead and answer. So far with 80, we only got half the people voting so far, but 85% of you are startup entrepreneurs. Give it a few more, give it a few more seconds here. We'll give it a full minute. How's that? I really would like to know who's out there. I see most of you are startup entrepreneurs, and that's cool. If I didn't introduce myself, personally, I'm a lawyer with Haynes and Boone. I'm a partner in the Palo Alto office in the heart of Silicon Valley, and I do corporate and tax. I work with a lot of startups in the emerging growth and venture capital space. Haynes and Boone, it's a large international law firm. We joined them last May. And that is what I do. 70% voting and 75% of you are entrepreneurs. We have a lot of other. I never get that other. I keep adding categories to try to get rid of the others, and it doesn't seem to help. There's always going to be some others in there. Okay, I'm going to go ahead and close the voting with 77% voting, and 76% of you are startup entrepreneurs. End of polling. Well, end of that poll, because I am extremely nosy, and I not only want to know what you do, I want to know where you're from. We're doing this event in Silicon Valley. It is 7 p.m. here, and that means it's really early in some other places and really late in other places. All right, more than half of you are from Silicon Valley, and about a third of you, more than half, almost a half, about a third are from other parts of North America. Okay, we've got Latin and South America. Oh, no way, 2 people from Fargo. Awesome, that's awesome. I lived in Fargo. You're from Fargo? I'm from Fargo. That's awesome. I just love meeting people from Fargo. How's the weather back there? How's the weather in Fargo today? Is it cold? Is it cold in Fargo? Remember when you used to get that? Anyway, so 10%, let's see. So we got 40% Silicon Valley, about a third from other North America. We have Eastern Europe is in the house. Latin and South America is in the house. No Africa, no Asia this time around, no Western Europe. Okay, I'm going to go ahead and end that polling. So you will notice that I did that through the chat feed, through the polling. You'll notice I sent my information through the chat. I'm going to do that again just so I make sure you have it, but I also want you to know how to have it. Now, there's a chat function, there's a Q&A function. I'm going to talk for an hour. I've got 30 some slides. I hope they take the whole hour. If they don't, and these are all new slides. This is all new content. I wrote it all up on Sunday. You are hearing it first. I'm a little curious myself what I'm going to say. All new content. If I do get through the slides a little early, I've got some backup slides, and I'll try to make it a little less legalese. I am a lawyer, unfortunately for you, because I will be talking a lot about the law. Keep in mind, though I'm a lawyer, I'm not your lawyer. This is not legal advice. It might sound like it, but this is just me giving you my general perceptions. You cannot rely on it until you sign an engagement letter with me. Now, if I get through my slides and I run out and I still have time, I have another set of slides called Tax Issues for M&A, for those of you that are still awake. If I get through those, I've got another set that I give to the American Bar Association called Advanced Tax Issues in M&A. So we'll see. I don't think I'll get to either of them, but I've got about 12 hours worth of material. In fact, if you want to stick around. Okay, if you want to tell me something while I'm talking, use the chat feature. If you want to ask me a question, because we're going to have a Q&A at the top of the hour from 8 till 8:30 California time, as soon as I'm done speaking, and I'll take your questions. Go ahead and type them in the Q&A box, and you can do that throughout the presentation while I'm talking. Okay, that's the Q&A box for questions. Chat feature is if you need to tell me something. I want to see if you can use the chat feature. So I'm going to ask you a trivia question, and let's see who can answer the trivia question in the chat feature. Here's a good one. In the movie, It's a Wonderful Life, what happened every time a bell rang? Every time a bell rang. Chat me if you know the answer. All right, Angel gets its wings. JR, you win the big prize. Yes, there was a sound, but that's not good enough. I'll give you half credit for that. I'll give you one more since you guys got that so easily. In the movie Home Alone, where were the McAllisters going on vacation when they left little Kevin behind? Does anyone know that one? No, I don't think it was London. I don't think it was New York. France is correct. It was Paris, France. Actually, I think that was Home Alone too, if I recall correctly. Anyway, good. You know how to use the chat feature. We've established that. Now, if you have any questions about my presentation, not about Christmas movies, although I'll take those too, go ahead and Q&A those to me. Okay, now comes the most difficult part of the evening, and one more chance for you to use your chat feature. I'm going to share my screen, and hold on here. I need you to tell me that you can see my screen. All right, so just chat me if you can see it, and you should see. All right, let's see here. I have 4 chats that say yes. All right, we're in business. Awesome. How to plan and implement a successful exit strategy. So first of all, I already gave you the disclaimer, so I won't give it to you again. This is not legal advice. This is just me. This is, I don't know, educational, I guess. Why are we talking about exits? Isn't this a terrible year? Isn't the economy down? Aren't we all stuck at home hoping we don't get COVID? Well, no, not quite. It's actually been a pretty good year for M&A. And in fact, according to PitchBook, North American's M&A report, in the third quarter of this year, Q3 of 2020, we had a lot of deal activity. In fact, it had its largest gain since the start of the pandemic last winter. So things have taken a big uptick in Q3. And I can tell you anecdotally, because I do a lot of this kind of work, I'm really busy. You know, I might have to cancel my Christmas vacation plans. Haha, that's a joke. Who has Christmas travel plans this year? But if I had any, I'd have to cancel them because things are really busy. There's been a big uptick. And you can see it's not quite where it was 2018. We had a big quarter, Q4 2018. 2019 was a big quarter. We're not at 2019 stages, but it's still a fair amount of activity. You can see from the chart. So if you're thinking of selling, I'll just tell you there's a lot of activity in the market. Why do you think that is? You know, why do you think that is? I have my own ideas, but I think we got this perfect storm of a really strong stock market, which gives people confidence. And plus currency, if public companies are acquiring private companies, they're using their stock as currency, and their currency is valued pretty high now. That means acquisitions are really cheap. Number 2, I think investors are getting a little nervous about this overheated stock market. I know a lot of people smarter than me are kind of worried about it. So they might be thinking about maybe expanding and putting money into smaller companies. And then thirdly, I think a lot of sellers are nervous about, about maybe now or never because the economy might tank next year. And then finally, and this has been the trend more and more over several years, you might not know this because I'm guessing, like me, you're probably a millennial, but there are a lot of baby boomers out there who are retiring. And us millennials might not understand that, but baby boomers want to sell their companies when they retire. And we're seeing a lot of that sort of activity. So a lot of strong activity. So it's worth talking about. So let me just kind of go through a few things. How to plan. When do you start planning your exit strategy? I think you start planning the day you decide to start your company. And we could spend an hour talking about choice of entity. I'm not going to do that. I do a whole presentation on that. I talk about that a lot. I do want to tell you, you've got 3 options as a practical matter. There's more. I mean, I've done foreign companies and business trusts and contractual arrangements, foundations, private foundations, public benefit corporations. There's a lot more, but for our purposes, there's 3. There's a C corporation, which is just a state law corporation, a creature of the state that does not make any special tax elections. There's an S corporation, which is a state law corporation that makes a special tax election to be treated as a pass-through. Tell you what that means in a minute. Or as an LLC, which the default is that it's treated as a pass-through or a partnership. The difference is the C corporation pays tax on its income at a 21% rate. And then when it distributes its income, the shareholders pay tax again. You know, for years and years, that's the last thing in the world you'd want to be, especially if you're thinking your liquidity event is going to be an exit, because you're going to pay this humongous tax when your buyer comes along and says, I want to buy all your assets. So now you're the C Corp and you sell all your assets at a big gain, you pay tax at the corporate level. When all that money's trapped inside the C Corp, it's like a big lobster trap, right? It was really easy to get into. Now, how do you get out of it? Well, you make a distribution or you liquidate. Well, then you, the shareholder, are taxed again. That was the nightmare scenario that we always tried to avoid. These days, it's not so bad. It's not so bad for a couple of reasons. We got a 21% federal tax rate. Joe Biden wants to raise that rate. I don't think he's going to be successful in that. Maybe it's 25 if he can get one or two Republicans on his side. Still pretty low. Still pretty darn low compared to the individual rate of 37%. But the biggest thing is that if you can talk your buyer, if you have a C corporation, and by the way, you probably, if you do have a C corporation, it's because you've got investors who wanted you to be a C corporation. If you're venture backed, you're a C corporation. That's all they will invest in my neighborhood. I know there are some funds that call themselves VC funds that will invest in other stuff. They're not the VC funds we're talking about, not the Silicon Valley VCs that are backed by tax exempt foreigners and high net worth individuals and large East Coast institutions. They're going to want you to be a C Corp. So you might not have had a choice at this. If that's the case, then you really, or for any other reason, you're a C Corporation. When you sell, you want to have a stock sale. And here's why. There's this thing called qualified small business stock. Talk about that in a minute, where you can reduce your tax, your federal tax on your gain to zero, up to $10 million or 10 times your cost. That's huge. Everybody knows about it. Everybody's psyched about it. It's why being a C Corp is not the pariah that it used to be many years ago. Even if you don't qualify for this benefit, you get a 20% capital gain rate. That's a heck of a lot better than two levels of tax at the corporate level, then at the shareholder level, which works out to roughly 30% if you do the math. Well, and then the alternative, of course, is if you're a pass-through, you pay one level of tax, but you pay it at 37%. I'm going to tell you how we get that rate down. Before I do that, I just do want to talk about this qualified small business thing first, because this is a big deal. What is qualified small business stock? It's good to think about and good to plan into and good not to screw up until you get to that exit. So planning for a successful exit, right? So that means that the stock issued to you is original issue. You didn't buy it from another shareholder, you bought it from the corporation. You held it for 5 years. It was issued after 2010, and you had to have held it for at least 5 years. At the time that you acquired the stock, the company did not have more than $50 million in gross assets, using a tax concept for valuation. So it has to be a small business. Here's one that people have been tripping on a lot lately. I've been getting a lot of questions about this. The company has to meet an active business test. What does that mean, an active business test? Basically, it means you can't be a consulting business. That's basically what it means. Now, does that mean a services business can't be an active business? The law is unclear on this. The law is really unclear, but this is one of those areas where you do need a tax lawyer to tell you whether you meet this requirement. And sometimes it's a little bit addressing the baby. Sometimes you might want to tweak your business model a little bit so that you do meet this test so you can avoid paying the tax. And sometimes the reporting that you do will make a big difference. When you file your first income tax return as a C corporation, you're going to have to tell them what SIC code. You know what a SIC code is? Standard Industrial Code, UR? Yeah. Think about QSBS when you do that. Don't report yourself as a consulting business if you're not one. I've seen companies do that, then we get in trouble. We have to go argue about it 5 years later when we're trying to avoid taxes. No significant redemptions. This is long and involved, and I don't want to put you to sleep just yet. I have a whole 40 minutes left to do that. But you want to be careful about buying out your founders, your co-founders, your other shareholders, buying stock back. Why is this a big deal? Because by the time a company gets to exit, the co-founders are always trying to take money off the table, right? They're trying to take money off the table. They're trying to do their double F stock or whatever. Yeah, be super careful about that. You might end up screwing yourself by doing that. Well, let's say that you're not a C Corp. You're a pass-through. You're an S Corp. You're an LLC. I personally think that it's okay to be a C Corp and do a sale because, like I said, the combined federal rate on the exit is going to be around 30%. So here's the thing. What did I say about the tax rate on pass-throughs? 37% is the highest individual rate. That's what you, the individuals, are paying in federal tax plus state on the gain from the sale of those assets. Well, there's this thing called the 199A deduction. It came in with the Tax Cuts and Jobs Act of 2017, and it is a 20% deduction for business income earned in a qualified trade or business. Now, there's limitations of that. It's 50% of W-2 wages or some other limitations. But for our purposes, the hang up on this is, again, are you a qualified trade or business? And the definition is very, very, very similar to that active trade or business for qualified small business stock purposes. So this is another one. If you are this kind of company, you want to take a hard look at this and plan into this so you can get that big fat deduction. That's going to bring your rate down to less than 30% federal. Now, again, I hate to bore you to death with tax, but what the heck, it's only my life, I guess we're talking about. It's what I do all day, every day. The problem here is that California doesn't allow a state and local income tax deduction. It does allow a C corporation to deduct the income taxes it pays to the state of California because that's a business expense. It doesn't allow you to deduct your taxes, even though they might have derived from a business. Well, that's a hassle, isn't it? That's not fair. So the IRS has been kinder and gentler, believe it or not. They really have these past 4 years. We think that might change. But they issued a notice recently that said, here, states, here's a roadmap. If you do these things, we'll let your residents deduct the taxes on the income from their pass-through entities like S-Corps and LLCs. Okay, I'm not going to get into it. If you want to know what those things are, you can go to my website, rogerroyse.com. You can see a letter that I sent to every single legislator and senator in this state saying, hey guys, look at this. Look what the IRS is going to give us. Would you please do something to reduce my taxes? A couple of them emailed me back, said, we'll look into it. I'm not holding my breath, but there may be a path out of this. So that's an aside. Go look at my website if you want to see what the answer is. Okay, choice of entity. We're doing good. We're on slide 7. We're right on schedule. Now we're going to talk about structural matters. Capital structure. So again, when do you start thinking about what you want to do and how you want to structure your company for a successful exit? Right on formation and right when you start setting it up. And as you're setting it up, you're going to be issuing stock. Now, eventually you might issue preferred stock. You know what preferred stock is? That's what the VCs want. It's a higher price type of stock, and it's higher price because when you sell your company, they get their money back first, unless they convert. Now these days, because of what's going on in the economy, you're going to see all sorts of fancy preferred. I spent the entire day today, in fact, drafting some very creative preference provisions because we're in that kind of market. One of the things I had to think about, and maybe responsible for the brain damage I feel right now, is what's going to happen to these preferences if we have a sale of the company? We know what happens if we sell it all for X dollars in cash, but that never happens. It's always a sale with some deferred, some cash, some is deferred till later, some sits in escrow, and some is sitting there in an earnout. You know what an earnout is? It's contingent consideration. It's where the seller says, I think my company is worth $10 million, and the buyer says, I think you're worth $5 million. And the party say, well, I'll tell you what, if the year after, the 3 years after I sell, we hit this level of revenue, you'll pay me 10. And if we don't hit that level of revenue, I'll just take the 5 I get at closing. So the earnout is a participation in the future profitability or gross revenue or some other metric of the company. You earn your consideration through future performance of the company. Sounds pretty slick, huh? We do that all the time to bridge that valuation gap between the over-optimistic, self-deluded founder who has to suspend reality to do what they're doing and kind of walks into the exit with that same sort of belief and just a tremendous hubris and optimism. To bridge the gap between that guy and your super conservative buyer who doesn't want to take any risk because they got to go tell their shareholders if it isn't worth what they want. And by the way, I've been doing this for 35 years. I've done hundreds of deals. I've seen them go well. I've seen them go bad. I've been on the sell side and the buy side. And I've seen what happens when a buy side deal doesn't work out, which is most of them. We can live with that. But if it fails just miserably because you priced it wrong, somebody gets fired, and that's pretty ugly. Where was I? Okay, we're starting our company, we're selling preferred stock. We know when we sell, it's probably going to be this earnout thing. Well, do my preferences get paid? I mean, what happens? Don't we convert it all to common? Do we just pay them first? So I'm not going to explain how we solve that problem. I'm going to tell you it's something you need to think about. And there is a path, there is a way to come up with a fair provision that the preferred stockholder, if we had time, I would do the math, but there's a way to come up with a provision where the preferred stockholder knows that they're going to get the upside if it's a $10 million sale, they'll get what they would have been entitled to in a $10 million scenario, and they'll also get what they would have been entitled to in a $5 million scenario. We can fix this, but there's little gotchas in there for your investors and for you, because you're going to have to be dealing with it on the back end. Equity compensation. So when you're setting up the company, you're going to be granted, this is Silicon Valley. We don't have a lot of cash, we got a lot of stock, right? So the value was built on equity compensation. That's where you give stock and options. And you all know that an option is a right to purchase stock at a certain fixed price. So equity compensation, we're putting our equity compensation plans in place right at the start of the company. A couple of things about that. So number one, those options. An option is the greatest thing that Congress ever came up with. Sometimes I feel that way. Think about it if you're the employee. Here you got a stake in the upside of the company, and it doesn't cost you a dime. You don't have to pay a nickel to get into that company. What you have is a right to buy stock at today's value. And when that company gets sold, the company's just going to give you the difference between the value of the stock then and the value of your option shares now. So you never pay a dime. You just get a big cash payment on the end. Or you exercise the option, you buy the stock, you hold it for a while, you sell it later, you get a lower capital gains rate. Either way, it's a pretty good deal for you. Think about it from a company standpoint. Company doesn't want 100 employees on their cap table. They got to give them notice, they got to invite them to meetings, got to send them Christmas cards, they got to do all this stuff you got to do for your shareholders. Let's give them an option. We have no fiduciary duties to an optionee. And that's the way the company's thinking about it, by the way. It's a great deal. And I'm not going to talk about 409A. That's just the rule that says options have to be granted at fair market value. So if your company stock is worth $1 a share and your company grants an option to somebody, their exercise price is $1 a share. It's not a dime a share. It's not a penny. Not what it was 6 months ago when you promised them the option. It is what it is when you grant them the option. Anyway, the reason I'm mentioning this is these options are really only valuable if you're the kind of company that's going to exit. And it's going to exit before we all get old. It's too late for me, but for you, it's going to exit before you get old. And that's the way the employee's thinking about it. So, so when you are using this sort of equity compensation, just keep in mind, that's what makes it valuable. You're the kind of company that is going to exit. Sooner the better, as far as the employee is concerned. Now, number 3, I want to tell you about a couple of things to watch out for. One, the dreaded change of control provision. Because every once in a while, somebody will come along and they've been to one of my lectures and they said, hey, I heard about this thing where, I have to work here for 4 years to earn my whole option. I got to vest into it. Investing means you earn it through continued service. But I heard about this thing that if you sell the company before I'm fully vested, all my options vest on change of control. So I've got an option for 10,000 shares. I vest 2,500 shares a year for 4 years. Would I say brain damage from earn-out provisions? 2,500 shares a year for 4 years, but you sell it after year 2. I'm only 5,000 shares vested, only 50%. I only get paid on 5,000 shares. That's a drag. How about if you have a change of control? I probably had something to do with it because I'm so awesome. You just vest me and give me the credit for all 10,000 shares. I didn't leave. I stuck around. I did what you asked. That's a change of control provision. Try not to do that. If you are doing that, stop doing that. Just stop it. Stop it right now, because that's going to make your deal way more expensive for your founders and your other stockholders, because the buyer's looking at that and they're looking at that valuable programmer and they're saying, yeah, that's great. We got vesting. We got golden handcuffs. We're going to keep this guy around and until they vest into all of their shares. Well, if you vest them all at close, the buyer has to come up with a whole new unvested share grant. And that's going to come out of your hide as founders, assuming most of you are founders. So I would be careful about change of control provisions. Parachutes are very similar. A parachute is the idea that, look, if we do sell this company, right? If we grow this company and then we sell this company, we're going to have bonuses all around for everybody. Well, not only is that expensive, I mean, keep that in mind, it also raises tax issues. I'm not going to go through all those tax issues now. If you stick around for the advanced section, I will. But for now, it raises tax issues. So you should be aware of it. A parachute, which is just a payment that's contingent, a compensatory payment on change of control, paid to what they call a disqualified person. That means a director, an officer, or a significant shareholder of the company. If you have any of those things going on, you might want to just rethink that if you're the company, because that's going to be a problem down the road. And if you're the person who has the parachute, there's ways to protect yourself. Get the company to agree to gross you up, put in a cutback provision, or there actually are some ways to sanitize the transaction on the back end. I just want you to be aware of it for now, that when you start coming up with all this creative stuff, you may be creating issues for yourself 5 years from now. Form of the deal. We're going to get into some stuff here in a minute, but let's take a step back and talk about how these deals are done. We're at 7:30 and I'm on slide 8. We're doing great. We're doing great. So there's really two kinds of deals in my mind and in my world. There are taxable deals or tax-free deals. Okay, and it usually depends on the currency or the consideration. What are you getting for that deal, right? In a taxable deal, whether it's a merger or whatever, that means you're probably getting cash or deferred payments. In a non-taxable deal, a tax-free reorganization, that usually means you're getting a substantial amount of stock, usually more than 50%, 40 or 50% of the buying company. So it can be a pure stock swap, right? Although we would do that as a merger for those of you purists in the audience. We rarely want to do what they call a type B reorganization, a stock for stock exchange. There's a lot of reasons for that, but just trust me on this. It can be 100% stock, or it can be maybe 50% stock and 50% cash. All right, I won't go through all the technical rules. I just want you to know those are two completely different animals, completely different animals. We go about them much differently, and it's the very first question that I ask when you get, in fact, I ask that at startup stage. I say, when you exit this company, who's your likely acquirer? And by the way, I'm extremely old. I've done deals with every big company in the Valley. I know how they are. I know what they like to do. Do they like to pay cash? Or do they like to give you stock? Do they like earnouts? So tell me who your likely acquirer is. So that tells me a little bit about what your likely exit currency is going to be. It's likely to be stock. It's likely to be cash. Why is that important? If it's likely to be stock, if you're dealing with a company that views its stock as again, currency to buy up other little companies, smaller than them, then you really, really, really want to be a corporation, because you can do a corporation stock deal tax-free. You can't do that with an LLC. So that'll tell me a lot. On the other hand, if I know you're going to exit to a company that only pays cash, we're not going to monkey around. I won't say who they are, but you might guess. Then I'm going to say, well, look, you're going to have an issue down the road, and you might want to think about everything I just said about C Corp, S Corp, LLC, and think about how we want to structure this. Okay, and then finally, the dreaded acqui-hire transaction. No one will ever tell you they've done an acqui-hire, but there is such a thing, and that's where the company has so much value wrapped up in the people but the people are so close to the trade secret that instead of just hiring all of the people, the buying company will simply acquire the company, and that way they get the people. Now, why is that so bad? The reason that might not be so good for you is if you're an investor in that company and it's an acqui-hire, that almost implies there's not going to be a lot left over for the investors. I'll show you why later on in the slides. But if the people are important, then the people are going to get a lot of the consideration, and we might have to restructure or recap even to get to that result, or carve out to get to that result if we have to. Plus, there is a stigma to acqui-hires. I mean, it means you didn't build a big enough goodwill asset, but those deals do happen, and they happen. You have to be super careful, by the way, if you're the kind of company that you think you're going down that path. If you should happen to pick up a copy of my book or email me, I will send you a digital copy. And in here, I do have a little chapter about a famous company in the Valley. I don't want to mention it now because they were a client at one point, but this was long after this happened. That was involved in an acqui-hire, and they were the buying company, and the selling company, had a lot of good people, but they just really wanted the people. And then the deal fell apart, and then they just hired all the people. That was a bad result for everybody. After the litigation and everyone got fired, it was a super bad result. It was so bad it made it into my book, Dead on Arrival. So you want to be careful about acqui-hire transactions is the moral of the story. All right. I don't want to get into too far without just saying there's a really often overlooked component to this. And again, I have an hour's worth of slides on this if you're interested, and that's shareholder level tax planning. Every year around April, I get calls from individuals saying, hey, I sold my company last year. I did not hire you to help me with that. Bad mistake, because my accountant just told me I've got this really bad result, and then we look at it and we say, yeah, you do. Here's what you should have done. If I could get my time machine, I don't know why you're calling me. I don't have a time machine. If I had one, here's what we would do. We would go back in time. We might do a little pre-transaction gifting, okay, so that we can move some of that big gain you're about to have out of your estate into a lower taxed bracket. We might do that by using what they call GRATs or intentionally defective trusts or things like that. There are things you can do to minimize the gain. These days, and by the way, there are tax elections. There are tax elections that you can make that are shareholder level elections. Also, it's counterintuitive. A lot of times an installment sale, you have to plan that well so you don't get taxed today for the money you're going to get tomorrow. That's all I'll say about it now. If you stick around for the advanced tax section, I'll tell you how that all works. Trust me, there's shareholder level planning that you have to worry about. You know what I'm talking to people a lot about these days is almost not a day that goes by I don't hear people want to talk about residency planning. What's residency planning? Well, suppose that you're in a high tax state, something like, I don't know, California. Suppose that state wants to raise, we're talking about raising the top federal tax rate to 16.2%. 16.2% on top of your federal rate, and you got a company you're about to sell. You might be thinking that, gee, if I lived over there in Nevada instead of here in California, that's 16.2% I don't pay. I think I'll go see Royce and ask him if he's got a way to get me into Nevada. Here's what I want to tell you about this. That is legitimate bread and butter, plain vanilla tax planning. I've been doing it since 1991. When I first arrived in California on the Mayflower. That is something we always do. So that part is good. Where you get in trouble is if you don't leave, if you don't really leave, you pretend to leave, you think you left, you leave and you come back too soon. There's an 18-month presumption, but I wouldn't hang my hat on that when there's a lot of money riding on this. This is something that has to be carefully planned into. And I'm not encouraging you to leave. I'm not at all. I'm very big on this state. I think you should all stay here at least until I retire. And I don't want you to pay attention to the fact that I applied to the Texas bar and joined a Texas law firm this year. That has nothing to do with my faith and confidence in the future of California. I think we're doing great. Let me talk a little bit about the process. Okay, now we're up to the stage and we're a third of the way through the slides where we're going to get into a deal. Now I'm going to share some war stories with you now because that's what us old geezers do. The process, first of all, you're going to put your team together. I'll tell you about that in a little bit. Your team's going to require a lawyer, an accountant, and a banker usually. And by banker, I don't mean the kind of banker you're thinking of. I'm thinking of an investment banker or a broker. Should you use a broker? 10 years ago, I said, don't use a broker. That's silly. Why do you want to pay somebody 6% of your, your deal proceeds, or maybe it's the, the layman formula. Why do you want to pay somebody to just get in the middle of your transaction and get in my way, while I'm trying to do all the important work here? These days, I don't say that, because these days the industry has gotten very, very good, and there are now federal and state exemptions from broker-dealer status, so you can use M&A brokers, and they almost always will add value to a deal. They will justify their fees. And that's changed. It's different from 20 years ago, when everybody in the world, claimed to be able to do this stuff. Now there are very good people out there. So I always tell companies, you should shop the deal. You should shop the deal, and you should make sure you're getting the highest price if you decided to exit. It's kind of like, selling anything else. Rely on an authority, rely on an expert. So a lawyer, a banker, or broker, and an accountant, because we want to get the tax right. And I want the accountant to agree with me, and I want them to understand what we're doing, so I don't have to argue with them next April. And then there's ancillary. Beyond that, there are ancillary people. There are experts or specialists. You might need foreign lawyers. You might need an environmental expert. You need all of those people, but that's your core. It's your core team. We have an initial meeting. We set goals and assign responsibilities, set expectations. You're going to get a letter of intent. That's where this thing kicks off. The letter of intent will arrive. There's room to negotiate. You don't even have an NDA yet, because all you've given, you've had some meetings with, and by the way, by initial meeting here, I mean the meeting you're going to have with your potential buyers. You've had some meetings. You've disclosed to them how profitable you are, probably. That's okay. You haven't told them anything confidential at this point. You haven't told them, but be careful about this. I'm going to talk more about this in a minute. You haven't told them, you haven't given them your employee list, and you haven't given them your customer list, and you haven't given them any specifications. You're being very careful. It's just, here's my high level numbers. What am I worth to you? That's the initial meeting. Hopefully you get an LOI out of that. The LOI is a very loose, informal, non-binding document. So they say, although watch out for that one. And the LOI is going to set the price, basically. Now, if you don't remember anything I say tonight, other than this one thing, remember this. Remember this. You will never, ever again have as much negotiating leverage in the deal as you do the moment before you sign that LOI. Okay? From the moment you sign that, the buyer is going to be looking for ways to reduce the price, because now you're committed. Even though it says non-binding, you're committed to act in good faith to try to close a deal with that buyer. If you don't, you're going to be back out in the market, and you're going to be damaged goods to the next buyer. So you really want that deal to close, right? Buyer knows that. So the buyer's going to use that against you. How are they going to do that? Well, the first thing they're going to do is send you a due diligence list, and they're going to start doing diligence on your company, right? They're looking for mistakes. They're looking for problems. They're looking for things that are going to reduce the price. You don't want them to find any of those. If you come to me before you sign that LOI, I'll find the problem and I'll fix it. And mistakes are free, except for legal fees, but mistakes are free before you sign with a buyer. Mistakes cost you valuation points if they're found by your buyer. So you want to fix that stuff. That's due diligence. So many companies, they don't even think about due diligence till after they sign. They should be doing due diligence a year before they sign and take care of these issues. Now, sometimes you can't, because the deal just comes up and poof, here it is, it's now or never. Well, let's just get in there and make sure that, we take care of anything before we start giving documents to buyer. If there's a problem, let's fix it. Okay, and most problems can be fixed, as outlined in my book, which you can have if you send me an email. Definitive agreement and then closing. I want to move a little faster because I'm not moving that well at all. I would love to tell you this story, but I'm going to get to meatier stuff. Just don't do these things without a lawyer, and don't do them without a lawyer that's actually going to help you with due diligence. Okay, that is my advice to you. You can do law light, right? I've had a lot of companies, I've seen that. They say, look, I'm not going to pay for a big law firm to do this. I'm going to just hire someone to just look at the agreement and tell me if that title looks right or whatever. If you do that, I'm telling you, you're going to spend 10 times that in litigation at the end. So let me just go through a couple of problems that I have seen people run into. as deals. One is the lawyerless deal. I don't want to spend time on that. That's kind of obvious. The bigger problem is, if you remember the Social Network movie, the movie that was about some big social network, the name of which escapes me right now. But anyway, in the movie, you may recall one of the co-founders is sitting in a deposition, and the lawyer says, "Well, gee, you signed this document that basically gave away all your shares, to your other co-founder. Why did you sign that?" He says, "Well, I thought it said this. I didn't know it said that." And he says, "Well, why didn't you ask your lawyer?" And he said, "I thought I did ask my lawyer." Turned out he didn't ask his lawyer. He asked the company's lawyer. That happens all the time. Happens all the time. You, as a seller of the company, you think that company counsel is representing you, but they're not. They're representing the company, and they're not obligated to look after your interests. Now, we can quibble about, expectations and third-party beneficiaries, but you need to keep in mind that there comes a point when there's an actual conflict between you and the company that's about to be acquired, and you need your own counsel. It comes up in employment arrangements, and it comes up sometimes if the shareholder consideration differs. But I've got lots of stories about people being surprised. Usually it's about April of the year after when they say, "Why didn't my lawyer protect me from this tax result?" Because he's not your lawyer. He's company counsel. He doesn't care what kind of taxes you paid. That's a little strong, I know, but I just want you to get the idea that you need your own advice. NDAs. Remember what I said? You're going to tell that buyer about the NDA. You're going to tell the buyer all the information about your top level revenues, income, etc., so they can price you. They're not going to sign an NDA at that point. Sometimes they will. Usually they won't. But then they're going to send you a due diligence list. Then you got to get an NDA, because now they're going to get in and look under the hood, and they're going to like, "Oh, so that's how you do it," and like, and that's the specs for that customer, and that sort of thing. At that point, you need an NDA. All NDAs are not created equal. Okay, all NDAs are not created equal. I've been through so many deals when I go through reading NDAs that people have signed without asking me, thinking, "Why did you sign that? That's not an NDA. That's a non-NDA." One case is that I'll give you an example of. There's a concept called residual knowledge. And sometimes you'll see a form bopping around a valley that has a residual knowledge clause. It means that, look, anything that I can remember is not protected by this NDA. If I walk away from this and it's in my head, well, that's mine. I won't steal any documents from you. I won't take any data. I won't walk out with a computer or anything like that. But if I can remember it, then it's not protected. Does that sound like really good protection? Keep in mind, stuff like that, works its way into pro-buyer one-sided NDAs. You need to have those reviewed by a lawyer. I know you don't think you do, but trust me, you do. Let me give you another one. This sounds a little arcane, but it's really not. And that's why I'm pausing on this. It's almost every deal that I do anymore, and for a long time, there have been adjustments that are based on the company's income. Usually it's a working capital adjustment, not income, but working capital. And working capital is defined by reference to accounting standards. And so they say generally accepted accounting principles. You can't just skate over that term and say, "Yeah, okay, generally accepted accounting principles," whatever that means. That is a term of art. It's a defined term. I'm also a CPA, tax only, so I can tell you that that is a very specific term, but there's some leeway within that term. There could be different interpretations of GAAP. The reason I'm telling you about this is because unless you've got an accountant, you are probably not GAAP, right? You probably are not GAAP compliant. If you're on QuickBooks or Quicken, God love them, you're probably not GAAP. And you might think you are because you're doing everything so logically, and you're an engineer, and engineers are smart. But this is not science. This is man-made. These are man-made rules. So there's no way that you could intuit this stuff. Okay, you have to get a professional to tell you that. Now, why am I harping on this so much? I did have a transaction one time, came to me years ago, and the price, and it was a typical startup company. They grew too fast. They didn't hire a CFO because who needs those guys? And they didn't hire financial professionals because who needs those? We're engineers. Instead, they kept everything on QuickBooks. They sold. The price was a multiple of EBITDA. All right, that's earnings before interest, depreciation, and taxes. There was a pretty typical working capital adjustment clause. The company was extremely confident that they were GAAP compliant, so much so that they refused to have an accountant come in and look at their numbers because they're so simple. How could they not be? That's just wasted money. Turned out they were not. They had understated their inventory. For the accountants in the group, that means that your cost of goods is overstated. That means your earnings is understated. Got it? Inventory is understated, costs are overstated, earnings are understated. Well, the price was a multiple, so their price was lower than what they would have gotten if they'd done it right. Oh, that hurt. That hurt when we found out. That just hurt. They called me up crying. I felt so bad for them. It was millions of dollars they left on the table. Didn't hurt as bad as what happened next, though. Well, wait a minute. Your inventory is understated. Your working capital's wrong, too. We have to lower the price even more because you lied to us about what your working capital was. So they got dinged twice. Hard lesson to learn, but don't mess around. You got to be able to stand behind your numbers. Okay, you got to be able to stand behind your financials. Due diligence. By the way, before we do that, I want to talk about the NDA a little bit. There's the other side of the equation. I told you about the weak one-sided NDA. There's an even worse NDA. I call it a super NDA that you'll see that bigger companies will ask for. That will prohibit it's the other way around though. It prohibit the target from disclosing anything at all about the company that they've done business with. You can't even disclose the existence of this agreement. That's not that uncommon. You can't disclose that you talked to us. You can't disclose that you entered into an agreement like this, like the substantive agreement we're going to do. Be really careful about anything that obligates you not to disclose before you get into the deal. And the reason why is because once you get into the deal, you're going to get into due diligence and your buyer is going to want to see all this stuff that you are not allowed to tell them. It's a problem that comes up almost every time these days. There's workarounds, but the best workaround is to anticipate this. And if you can't anticipate it, then deal with it responsibly when you get there, but be aware of the issue. Those documents mean something. Those words are important. Due diligence. There's a million things you have to think about. I won't go through them all. I have a list here. If you email me, I'll send you a standard due diligence list so you can see what I'm talking about. But trust me, every one of these will result in a valuation adjustment if we find a problem in due diligence. And we almost always do. I have a friend, he's a partner at a Big Four accounting firm. All he does is, see, it's not even on here. All he does is put out his benefits, number 6. He tells me he adds value. He works for buyers. He adds value to a deal by finding a problem with their benefit plans. He says he will find a problem 99% of the time. He will get a reduction in the price because they did something wrong in number 6. That's how carefully they're going to look at you. One more thing, going along with the super NDA, there's also the ROFRs. So you might have done a deal, especially if you took money from a corporate venture capitalist or strategic investment. But even if you just entered into a contract with them, they have a right of first refusal in the documents. What does that mean? That means you can't sell to anybody else as a practical matter. It means before you can sell your company to someone else, you have to offer it to them. Never, ever, ever sign one of those. That means you can't sell because no buyer can even get to the first stage, without getting past this right of first refusal. They won't even get to a letter of intent because why bother? A softer version is called a right of first offer. That's not as bad. It just means, you'll offer it to them. If they turn down your offer, then you can go out into the market. It's not great, but okay. And the weakest way is the right of first look, where you don't have to make an offer. You just have to say, we're going out into the market. If you want to buy, speak now or forever hold your peace. That's not so bad. Just make sure you understand what you've signed. And I know I've been through this enough times, when Big Co is asking you for this stuff, it's like, well, we just want to have an opportunity, to be in the mix. If you ever should decide to exit, these are just guidelines, Remember that movie Ghostbusters? Remember that line in there? I have a strict rule against getting involved with ghosts or something like that. Well, it's not really a rule. It's more of a guideline. Sigourney Weaver, Dennis Murphy. All right, never mind. Reverse due diligence. Beware you have to do diligence on your buyers as much as they're doing diligence on you. I had this thing I like to call a professional buyer. What do I mean by that? That means somebody who does this so much, they know every trick, they know every game, they're playing games. You'll know almost immediately if you're dealing with a professional buyer, and it's it's like playing against the Queen's Gambit. And you'll realize when you're halfway through the deal and you can't get out, you know that checkmate's coming. Well, how do we know if we got a professional buyer? Go take a look at the SEC filings, take a look at what their documents look like, see if they've had any disputes with anybody over their deals. Have they sued anybody? Have they been sued? Um, be careful about that. Know who you're dealing with. It is like the most important thing. And also, I won't put this on a slide, but you can, you're known by the company that you keep. You might see who their lawyers are too. They have a very aggressive litigation firm behind them. That might tell you something. Financings. So you need to know, is your buyer able to pay, they can be able to pay for you, right? So you want to do a little financial due diligence on them. A lot of times the buyer will tell you, look, we're going to leverage the deal, right? So we're going to sign this letter of intent, then we're going to go raise money. And then when we raise the money, we're going to come back and pay you and close. I don't have to tell you how risky that is. So just know what you're getting in for and be confident that you're going to make that happen. There are strategic buyers and there are financial buyers, right? What do I mean by that? Strategic buyers are in your industry. There's a strategic fit. They're going to take your widget and attach it to their gadget, or I guess they say Reese's Pieces now, whatever it is, it fits their business. That's way different than a buyer who says, well, I'm going to buy you and then I'll buy another company and then we're going to roll you up and we're going to go out to the market and sell you. And the people who run in the deal are thinking just financially. They're thinking about the numbers. I'm not saying one's better than the other. I'm saying they're different. They will approach the deal differently and you should approach the negotiation differently. So just know who you're dealing with. Rob, we should do a whole session on negotiation strategy because that's what this gets into. Deal terms. Let's talk about a few of the deal terms. One of the big deal terms that's going to come up is what's going to happen to you. They're always going to want you to transition, okay? They're going to want you to transition. That means you got to stick around and you got to help bring the company over. Now, the dirty secret about M&A activity is not very many of them are successful. I mean, they're just not. If you look, and they're not successful because of improper integration. It's better now than it used to be. So, they're going to try to integrate you, but if they can't, because you're a founder, you need to be prepared for that. And, I tell people, just don't feel bad. You're 6 months to a year from now, you start getting really restless because you were your own boss for a while. And now you're a cog in a machine. You're a pawn in a chess game. You're taking orders from somebody else who you may or may not like. And you might find that work environment to be toxic, as one founder once told me in this scenario. So why do you need to anticipate that? Because you want to make sure your consideration is going to get paid to you, even if you leave or if you get fired. And if you have vesting provisions on what you're getting paid, which is very common, you want those to be very fair to you. You also want to spend a little time figuring out what it is they can fire you for, because you can always get dismissed with cause. And everybody says, well, that's a really high standard. It's got to be cause. Well, yeah, it depends how you define cause. There's little things in this that you need to pay attention to. I could tell you stories, but I won't because we're out of time. I'm just going to use the last couple of minutes to tell you that in the definitive agreement, which is almost the last step here, this entire thing, these are all the things that have to be negotiated. Now, I just want to focus on one thing in these 2 minutes, is number 9, because this is what's new. MAC is material adverse change or material adverse effect clause. These days, because of COVID, we're seeing that pop up. Be sensitive to that. I had a transaction that closed in March that I worked on. I represented the seller. The company was involved in a air transportation business. And right before it closed, we were negotiating really hard over some nickel dime little issue that was all about ego and not so much about the deal. And I said, I know I'm a lawyer and I'm just a worrywart, but this COVID thing, I might be a little worried about that in your business. I think I might let that one go just to get this thing closed. And we did, and we closed it. But suppose that we hadn't. Suppose that we still fought over that $20,000 issue another week right into the shutdown. The buyer, there's a 100% chance that buyer would have said, material adverse change, I'm out of here. Your business is no longer relevant to me. You can't do business. You're shut down. So now we're seeing clauses pop up in agreements where we say, by the way, COVID is not a material adverse change. That's one of a million examples I could have for you. I guess the point being that definitive agreements require a lot of thought and a lot of effort. We are now at 8 o'clock. And what I'm going to do is I'm going to stop sharing my screen and I'm going to open things up to questions. Okay, where's my Q&A box? So if you have a question, go ahead and type it into the Q&A box. You know what? While we're waiting, I think I am going to go back to my slides and keep going because I didn't get through half of them even. So I'll tell you what, let's go on back to the slides. I'm going to keep my Q&A box open. So if you have questions, just let them rip as I go along here. So let's go through a couple of other things that might come up in a definitive agreement. So, oh, wait, we got a question. Did I share my email? I think I did. Tell you what, let me do that right now. That's the one thing I didn't share. But you know it. One thing people want is the one thing I forgot to share. There it is. It's at the bottom. All right. Typical definitive agreement. All right. Price, of course. You know, we got that. Currency, consideration. We went through all that. Is it stock? Is it cash? Etc. Now let's get into the stuff that you're not thinking about, top of mind. Reps and warranties. You're going to be required to make a lot of reps and warranties if you're the seller. Those reps and warranties, oops, okay, answered. Done. Those reps and warranties are representations and warranties. For example, you're going to represent that you own the company that you're selling. You're going to represent that you're not being sued. You don't have any claims you haven't told anyone about. You own your intellectual property. You don't have knowledge of infringement. It goes on and on and on and on. You'll be surprised. You'll be surprised when you see it. If you're on the sell side, you'll probably freak out. Like everybody does. And when I work with buyers, I draft this and even my buyers freak out, but that is standard practice. This protects everybody. You don't, and this is why you don't do a lawyerless deal. This is why you really want to lawyer this stuff. Get the stuff up front and get it out of the way. Now, the reason I'm telling you this is because you're not going to be able, it's rarely, it's never, you can give a clean set of reps and warranties. There's always something. I represent there are no claims out there. Well, except for that letter from a lawyer I got last year. So there'll be a schedule attached to your definitive agreement that says, this qualifies my reps and warranties. Remember in the reps and warranties, when I said no claims, I said, except for this one. So what that does for the buyer, it smokes out all this stuff. It forces you to disclose to them. And then you can decide whose problem it is. If you don't put it in the document, it is your problem as a seller, okay? Just keep that in mind. And I know what you're gonna say. Well, I told you about that claim and I put the complaint in the due diligence room, the data room, and you knew all about it. Well, unless you have what they call an anti-sandbagging clause, which you rarely get, if it's not in that agreement, you know, you're toast. I mean, it's your problem. That's how the agreement allocates the economic cost and risk of all of those things. So the rep is not so much, did I tell you? Did I not tell you? Did I hide it? You know, did you know about it? The rep is more whose problem is it? So just when you look at reps and warranties, think of it that way. If there's a tax out there that I forgot about, whose problem is it, right? That'll change your view towards reps and warranties a lot. Indemnification, I'm going to get to that in a second. Well, let's get to it now. Indemnification, if one of those reps and warranties is wrong, what happens? Indemnification means that you, the seller, or the company, if you're selling a division or assets, you have to indemnify, you have to make whole, you have to pay the buyer the damages or the loss or the cost of that breach of representation or warranty. That's an indemnification. Almost every agreement has. I'm going to get to this in a second. But indemnity is always capped. It's always limited by time, and it always has a floor, which we call a basket or a deductible. So in other words, you don't want to have an indemnity that's unlimited. I'll tell you what right now what happens why you don't do that. But like an indemnity cap will typically say, look, if there's something wrong with these indemnities, provided it wasn't fraud, provided it wasn't fundamental, like I didn't lie about owning my company, if it's something that I just honestly, an honest mistake, I forgot about that employee claim, or I didn't know I was infringing somebody's trademark, okay, I will pay you, but only up to a certain percentage of the purchase price, right? Or a certain dollar amount. And you have to bring me that claim within a certain amount of time. At some point, I have to stop looking, over my shoulder. So you have to tell me within like a year or two. It's limited by time. And anything that comes up after that, that's on your watch, not on mine. It's your problem, not mine, even if it happened while I own the company. And then the third thing, the basket or deductible, that's the idea that if there's, you don't want to deal with a bunch of little claims. So you'll say, look, that loss has to be more than X dollars before you can come bother me with it and make me indemnify you. And a basket means it just has to exceed a certain amount, and then the seller is responsible for all of it. Deductible means once you hit that low amount, the seller is responsible for everything over it. It's a deductible. Okay, we have a question. I'm going to get to it, but first I want to tell you about indemnity. So why do you cap the indemnity? Many years ago, I had a client, we did a sale of some assets to a large foreign buyer, and there was a cultural issue. I said they sent us a document. I said, let me mark this thing up. This is the lawyerless deal. Let me turn it into a US style, fair, even-handed market document. And my guy said, no, that would offend the buyer so much. They're such a well-respected big company, and they're a household name. They're one of the biggest companies in the world. We can't do it. We just have to accept it. What they were buying from us was a little gadget that was going to go into their big gadget, which they were going to sell, billions of dollars worth around the world. So against my advice, we had no indemnity cap. Turned out our little gadget, nobody noticed when my little company was selling it, but when the big company started selling it, somebody noticed. Turns out that my company's little gadget infringed. It infringed somebody's patent. So we weren't allowed to sell it. So of course, the big company, they came for an indemnity claim. What do you think they wanted? Do you think they wanted their money back? Yeah, they wanted their money back. They wanted something else too. They wanted consequential damages. You know what consequential damages? Here's how much money we would have made off of your product if you hadn't lied to us, if it had done what you said. This is the benefit of our bargain. You owe us $1 billion, $1 billion. That was the indemnity claim. Bankrupted the company, by the way. So that's a mistake no one should ever make. All right, I want to go to the question here is what's the important and the advantage of doing grants for exit planning? So a GRAT is a grantor retained annuity trust. It's a creature of statute. That's why we love them. So you have a lot less risk on it. And what it means is that, say you have stock in a company and your stock's worth $1 million, but you got the next big thing. And that stock's going to be worth $100 million. Down the road. Okay, I'm going to stop sharing for a second. That stock's going to be worth $100 million down the road. And then you're going to sell it and you're going to pay the tax. And then you're going to have, your $60 million, $80 million left over or whatever it is. And then you're going to die and you're going to give, that money to your kids and you're going to pay like 55% estate taxes on it. So they get half of it. Nobody pays estate taxes in this country. I'll just tell you, it is an almost voluntary tax. It is so easy to get out of. I hate to say that, but I am a tax lawyer, so I have to be honest, I guess. How do they do that? Well, a GRAT is one way. It's a leverage gift. You gift the stock to your kids. You gift it when it's only worth $1 million because there's an exemption. You can currently, you can gift, between you and your spouse up to more than $10 million during your lifetime of property. That's probably going to be limited under Biden as well, by the way. But anyway, well, that's cool. That's good. But what if I got $10 million worth of stock? I'm going to blow through my exemptions. Well, there's a way that you put it into trust and the grantor retains an annuity. Okay. So here I'm transferring the stock to a trust. The trust is for the benefit of my kids. I get this payout for life and the kids get what's left over. So we lock the value for gift tax purposes and estate tax purposes a low value now, so that when I do die, they get the property that low value that doesn't get taxed instead of the proceeds at that high value that does get taxed. It's a very common strategy and there are many variations on that. We could talk for hours about it. But it's the kind of thing you should be thinking about. You should be thinking about when, if you think you're going to be in a taxable estate at some point. And like I say, the tax law is going to change depending on what happens in Georgia. And we may all be in a taxable estate planning environment by the time January rolls around. So something to think about. Next question. What mechanism, contractual or otherwise, does a company have to shop the deal to different acquirers? This applies in particular when there's a short list of known acquirers in your specific industry. Let me take a swig here first. I'm talking a lot, so. Well, so here's the thing. You can go out and shop the deal before you sign anything. You can go out and you can make discrete inquiries. You have a short window because word's going to get around. And you don't have an NDA when you first start talking to companies. You might get an NDA, but you probably won't immediately. So word might get back, and word might get back to your employees and to your customers and to your suppliers, and they might get nervous if they hear this stuff. So you want to be really careful about that. Again, another reason I think bankers are good, because they can run interference in this stuff. Because once you do engage with somebody, you want to get to an LOI and a confidentiality clause as quickly as possible. Now, once you get to the LOI in the best, sweetest world of all, and I'm in a deal like this now, you could have a couple like this now, or you could have a company that has multiple LOIs and you just kind of weigh the options, play them off against each other. Don't waste too much time, because you have a shelf life once you go to market, once you're in play. So the mechanism, the mechanism is an NDA, but you're not going to get it. So the mechanism is getting to that letter of intent quickly. Now, the letter of intent is going to have two things in it that are binding. Remember how I said it's not binding? Two things are binding. One, a confidentiality clause. Whew, okay, you're not going to tell my employees that I'm about to sell the company, because they might not be happy about it. They might get nervous. I want to be able to make an offer to them, and tell them personally or whatever. So there'll be a confidentiality clause. That's great. Secondly, however, there will be a no shop. What's a no shop? A no shop says for a period of time, it's usually 90 days, you are out of the market. You got to give this potential buyer an opportunity to close the deal with you. Got to give them a fair shot at it. That's a no shop. That means you can't go talk to anybody else. And the way most no shops are drafted, it means not only can you not go out and shop the deal, you can't entertain any offers from anybody else. And if you do get an unsolicited offer, you got to run down the hall and call the buyer and say, hey, I got another offer and here's what it is. That's how most of them are drafted. We negotiate this language sometimes, but just the point being is that you're not selling to anybody else once you sell it until that letter of intent expires. Now, let me come back to one thing. Everybody says, oh, it's non-binding. It's a non-binding letter of intent. It is and it isn't. Those two provisions are binding, but there's a third provision that's not in the agreement that's binding that the courts have implied, right? The courts have written this into the document, even though it's not in the document, especially here in California, where we have, wait a minute, I guess I can mark this done, where we have judges that are willing to go in and supply terms that the parties might not have thought about. And one of those terms is an obligation to good faith and fair dealing. So once you sign that letter of intent, you're telling your buyer, I intend to negotiate in good faith with you to try to close this deal. If you don't have that intent, you may be in violation. Can you get sued for that? Oh yeah, and you will if if you're not acting in good faith and your buyer finds out about it and you sell to somebody else, and they could have gotten, especially if it's a higher price, because you've denied them the benefit of their bargain. So keep that in mind. And that was on no shops. I don't know how we got off on that. So, okay, let me mark that done and let me go back to screen 2. Awesome. I love it when the technology works. Okay, some other provisions. So everything I told you about indemnification. So lately, deals have been using reps and warranty insurance now. And it used to be, so this, in other words, you, instead of having the parties try to decide who's going to take the risk if something's wrong with the company, you just buy an insurance policy, you pay a premium, just like any insurance. An insurance company will pay if there's something wrong. There's a tax claim that wasn't disclosed. You know, there's litigation you didn't know about. You didn't own a piece of IP. There's a trademark dispute, whatever it is. Insurance pays for it. Now, early on, there was a time when the insurance was so expensive, we could only do this for bigger deals. But now it's kind of like fire insurance. There's been enough fires that we got statistics. So there's data. So the insurance companies can price smaller deals, and they can price them competitively so that it makes sense to have rep and warranty insurance. And this is something I see in almost every deal now. The buyer will usually ask for it. Who pays the premiums? Let's negotiate it. You figure it out. It changes your reps and warranties. It changes them a lot. They're not going to be, my experiences are not as heavily negotiated anymore. They're a lot lighter. They're a little easier because you're insuring against the risk. So it's really what can you and the insurance company agree to. Okay, dispute resolution. Disputes do happen. Even sometimes successful deals that closed well and everyone was happy about it. Oftentimes they end up in disputes. Usually it's over an earn-out provision. I'll just warn you. And there's not, all the words in the world just can't protect you from that. In the law, we have this thing called the principle of relative ambiguity. It means that no matter how carefully you try to define a potentiality, like you define income, so carefully, somebody will find something ambiguous about the definitions you use to define income or whatever it is. You're never going to get away from ambiguity, no matter how hard you try. So if you have a kind of buyer and a kind of seller that just don't get along, you may have litigation. Disputes come up over earnouts. They mostly come up over reps and warranties. That's going to happen a lot less now that we got insurance. They come up over working capital adjustments. People don't agree on working capital. They don't agree. My gap isn't the same as your gap. This should be a current liability and you didn't include it. Stuff like that. That should not be a current asset. Inventory valuations, I see those disputes. There's a million ways. There's a million ways to die. So why am I telling you this? Because you need to think about how you're going to resolve those disputes. Usually you'll have an accountant resolve like the financial stuff, like working capital. You'll have a referee who should have a financial background resolve it if you don't agree with the accountants. Oftentimes you'll have arbitrators if it's a legal dispute, but some people hate arbitration and they'll just use the court system. Which court you agree to use is really important, and whose law you're going to apply. If you apply Delaware or New York law, they have a reputation for they enforce the contract just how it's written. Whatever's on that paper, that's what matters. If you've got California law, they tend to look more towards intent, which some people hate because they want the certainty of what's on the paper. In any case, wherever you litigate is going to be very important because you can have one court applying a different state's law. We have that all the time. But to have to travel to a foreign jurisdiction to litigate, it's hard to do as a practical matter. Your witnesses are all here, but your court's there. You can't get your witnesses, stuff like that. It makes a difference. It makes a difference when you get into negotiating these disputes. The best dispute resolution mechanism is not to have disputes. And the best way not to have disputes is to, first of all, know who you're dealing with. And then secondly, anticipate them and just draft ways around them if you can. So like I say, relative ambiguity, but you can avoid that by really not trying to hardwire so much that people always want to do. Covenants, these are the promises of things that you're going to do after you sign and also after you close, who's going to file the tax returns. Here's the biggest covenant in any deal is the non-compete. Yeah, be careful about that because I know you're thinking, especially if you're one of those baby boomers, yeah, I'm going to exit, I'm going to retire, and I don't care, I'll sign a non-compete. I'm never going to work in that industry again. Well, what if your wife doesn't want you hanging around the house all day, every day, and you decide you got to go out and do some consulting? Are you violating your non-compete? Think about that. Leave yourself a little room to do something that's not going to adversely affect the business that you sold. The point of the non-compete is to preserve the goodwill of the business, right? Because that's what you're selling. Let's take a step back. Think about what you're selling when you're selling your company, especially my clients, tech companies. And I do some base economy companies. I've sold, cement factories and vineyards and all that sort of stuff, but mostly it's tech companies, plastics manufacturing, tech companies. What do they have? Well, they've got some technology, granted, low basis, high value, probably a patent and some trade secret. They've got goodwill. What is goodwill? That's the fact that everybody knows how awesome their product is, and that they've got the expectation that those people are going to return. So think of the really big names out there in social media, etc., and think about how valuable that name is, right? So that's one of the assets. So what do we have to do to, and then they have the people, right? The relationships that they have with their people and the relationships with the customers. So how do we protect those sorts of assets? It's not like you're selling a chunk of real estate to Donald Trump and you can just transfer the deed and then you don't have a problem with it anymore, right? That's how do you protect like a goodwill or a trade secret or a trade asset? You do it through contracts. You do it through good agreements, and non-compete is what protects the goodwill. All right, if you sell your company because you've built up such a good reputation, if you go and start doing the same company across the street, people might come from the old company to the new one. So the non-compete protects that. That's what it's supposed to do. It's not supposed to keep you from making a living ever again. So, so be careful about that. Conditions. So conditions, those are things that have to happen in order to close. Escrows and holdbacks, if you're a seller, if you're nervous about your buyer. So the buyer is going to like reserve a little bit to compensate them for any lies that you told them in the document, right? If you breached your reps and warranties. So they might just hold back 10%, we'll say. But if you're a little nervous about it, you might ask for an escrow. Escrows are expensive, I'll warn you, but they're done and they're out there. So that 10% goes and it sits in an escrow for a year, and then you go tell the escrow holder when the year is up that there's been no claims, give me my money. You do that if you're just worried about having a solvent buyer. Price adjustments and gap, we talked about. MAC and COVID, we talked about. All right, let me see if anybody's got any questions, go ahead. Otherwise, there are a couple other things I want to tell you about. Just a couple of practical pointers I'd like you to walk away with before we're finished here. It's just some practical stuff. Again, I want to go back to this, who's the lawyer here? I was involved in a transaction many years ago. I came along after it was all done. So I did not do the deal. I came to clean up the mess that was left after this. And this was a professional buyer like you've never seen. And they stuck this poor target, these sellers, every which way. One of the ways they got them is they went back to the seller's law firm, one of the largest law firms in the world, and they said, you belong to us now. You work for me. We bought this company. We want every communication you ever had with this target. And the seller's law firm said, we're not going to give you that, attorney-client privilege. And the buyer says, we own that privilege now. We bought it. We bought the company. The seller's law firm put up a good fight, but in the end they lost. They turned over those emails. Well, within those emails were some extremely damaging things. About don't tell the buyer about this because they'll walk away. Don't tell them, that this asset is this, and how do we keep them from finding out that? These are to the lawyers for the seller. That's fraud. I mean, that's the worst thing you can do in a deal. Now, first of all, they shouldn't have done that. And they should have been counseled to come clean. But if they weren't going to come clean, they shouldn't have done the deal. But man, oh man, the lawyers never should have gotten. Yes, millennial. That's Joan Rivers, by the way. For those of you who are not fans of the Johnny Carson show, she used to say, "Can we talk?" All right, sorry, Rob. I will update the graphics on my slides. I'll find some rap star or something. Anyway, what is now done regularly in almost every agreement is a clause that said, hey, buyer, whatever you're buying, you're not buying me, okay? You're not buying the attorney-client privilege, so don't even ask. You agree that you're not acquiring that. So that's pretty much standard stuff these days. That's one little trap. Similar to that, you also want the agreement to allow you to use whatever lawyer you want if you do get in a dispute, because the lawyer who did the deal is probably going to be really helpful in knowing what parties intended if you have to go argue over what it meant. Okay, I want to talk about some liability issues because, we are heading into a down economy. And we have a whole presentation. You'll find it online. You'll find it on the Royse Law YouTube page. If you want to see the video, it's an ID to IPO event. It's called Startups in a Down Economy. And I spent a lot of time talking about all the bad things that can happen. So let's talk about the bad things that can happen in an unsuccessful exit, one where not everybody is happy, where somebody's ox is getting gored. 3 ways this comes up. 1, fiduciary liability. So if you're selling your company for less than your shareholders think it should be, you want to be careful they don't come back and sue you, the board, for messing this up. Okay. You also want to be sure that the creditors of the company don't come back and sue you if they don't all get paid. Secondly, you want to ensure that you do not, I had somebody ask me, a client once emailed me and he says, I heard about these minority shareholder unfairness claims. They call them Amundsen claims in California, named after the famous case where a small shareholder sued the big shareholder because the big shareholder controlled the company and forced a sale that didn't get him as much money as he wanted. So that's not what happened in a case, but that's how the claim comes up. So I heard about these minority shareholder unfairness claims. How do I not get sued for being unfair to my minority shareholder? And I typed it back. I said, don't be unfair to your minority shareholder. That's the answer. Be careful about that. Be cognizant. Don't be unfair. Now you can sanitize these transactions by having a majority of the board approve them. Disinterested majority, not you, but a disinterested majority. Or if the disinterested shareholders will approve the transaction. It's hard to find a disinterested board in anything these days. So if you can't meet that standard, then the next standard, there's a famous case called In Re Trados, Delaware case that took place in California, that you might look at. If you can't meet that standard, then the standard is what they call an entire fairness standard. So if you go watch the video, we've got a whole hour on how to make sure that if you're in a troubled company and you're having a down exit, that you protect yourselves from these sorts of liabilities. Creditor duties. I just want to point out to you that once you become insolvent, meaning that your liabilities exceed your assets in your company. So when you sell, you're not going to pay back all the creditors. You have to worry about your duties to creditors. Okay, duties to creditors. Just keep that in mind. You have to treat them fairly, just like they were shareholders. That's a whole nother discussion. I'm just going to raise it for you. Let me just kind of give you some examples here. So it's public knowledge. So I had a little piece of this case as well, but there's a small company turned a little big and sold to a much bigger company. The board was controlled by the venture capitalists. The selling company's board turned down an offer for $825 million. $825 million for a sale of the company. No, we don't like that deal. Shortly thereafter, they accepted a deal for $500 million to a different company. Why would they do that? Why would they do that? They're stockholders, for Christ's sake, and they're on the board. Well, when you peel the onion and pull back the, kimono or whatever, what we found out is that the VCs, they were capped in that deal. They were limited on how much money they could get. They had non-participating stock. That means they don't share any upside. They put in $1, they get the first $5 back and they're done. So they didn't care whether it sold for 500 billion, 10 billion, didn't matter. As long as they hit 500 million, they got all their money out of the deal. Okay, well, that's bad, but then it gets worse. Plus, the buyer they sold to said, look, we got these side deals with you. We're going to make these other transactions. We're going to hire your good friend there to come, work for our company. We're going to put them in place as officers. We're going to do some more business down the road. Okay. So you can see that we had a conflicted transaction. So as you might expect, everybody got sued. Now this happens a lot. And what you have to understand is once you get into a deal, the VCs and the management, your interests will diverge. Now in that case, it was a deal that favored the VCs and hurt management. Usually it's the other way around, right? Usually the deal is that management is out there in the front lines negotiating a deal, and they negotiate themselves what they call a carve-out plan or some sweet deal or some sort of bonus on sale, and then they get in trouble with their investors. And when that happens, this is what happens. You guys end up in litigation. So, take a look at the Trados case. I'm happy to talk with you about that. We do a whole hour on this. Take a look at our other slides on deals in a down economy and how to avoid that problem, because you do not want to see that guy. Instead, you want to see the friendly happy event lawyer, which is this guy. Okay, with that, folks, I want to wish you all a Merry Christmas and Happy Holidays, and thank you all for being here. This is it for me for the rest of the year. I don't know if ID to IPO has additional events. I'm sure they do. You can check out their webpage to find out. And with that, I am going to go ahead and conclude. Thanks, and see you next time.